I want to share with you guys today what I'm doing with my money given the current level of overvaluation of the stock market. I am working on a 3-component ETF, and which are they? I got 40% of my money into QQQI, which is a Nasdaq cover call ETF provided by NEOS. I got 40% into CCD, which is a bond fund by Calamos, and 20% into Treasury bill ETFs. I consider the 20% Treasury bill ETF portion like dry powder. If something was to happen to the stock market, like a stock market correction or even a stock market crash, that is going to be my dry powder to deploy when the opportunity presents itself. Like when everyone panics and they are going to sell their stocks, the stock market is going to plummet, you are going to have the money when you need it right there to buy your favorite stocks at your favorite price. QQQI is going to provide 15% nearly annualized dividend income, which is great. Plus the appreciation in the case the QQQ is going to go up. Of course, if the QQQ is going to go up 10%, the QQQI is not going to go up as much because it is capped by the cover calls. But regardless, you are going to collect the 15% annualized dividend yield. I really doubt that the QQQ is going to go up 15% over the next year, while it's already up over 10% year to date with all the issues that we have going on, the Iran war, the gas price, sticky inflation, possibly the Fed is going to be forced to raise rates. All of those things Wall Street don't like. CCD is going to provide you with stable income. At the time of this recording, CCD is paying nearly 10% annualized dividend yield. Right there is your stable income regardless of what the market does. Over the past 10 years, CCD is up over 30%, and the price doesn't fluctuate a lot, providing you with income, rain or shine. The QQQI is going to drop if the QQQ drops, but not as much. That is because of the juicy income. If the stock market was to drop, people are going possibly to panic sell, and they're gonna go into cover call ETFs to collect the income. Now we are currently in uncharted overvaluation territory for the stock market. The Buffett indicator
measure of where valuations stand at any given moment. The Buffett indicator evaluates whether the overall stock market is overvalued or undervalued relative to the size of the economy. How it is calculated. The baseline formula is simple. It compares the total value of all publicly traded corporate equities in a country to its overall economic output.
Indicator is sitting at about 220%, while the Shiller-Cape ratio.
The Shiller-Cape ratio, short for cyclically adjusted price-to-earnings ratio, was developed by Yale University professor and Nobel laureate Robert Shiller. Like the Buffett indicator, it measures whether the stock market is overvalued or undervalued. However, while the Buffett indicator compares stocks to economic output, GDP, the Shiller Cape looks directly at corporate earnings, adjusting them to smooth out short-term economic distortions.
So it's sitting at over 39. Those are levels not seen since the 2000 dot-com bubble, or even back in 1929 recession. History teaches us that if you buy individual stocks during time of overvaluation like this one we find ourselves in, your return over the next 10 years is going to be -2 to +2%, and that is over the next 10 years. That's why I decided to put the bulk of my money into QQQI and CCD that combined provide an interest of 12% annualized. For me, this was really a no-brainer, and I want to get you guys to think and give you guys some food for thoughts about this. Now think about it. You are gonna collect 15% on one side of your investment and 10% on the income side, while you have dry powder to deploy when the opportunity presents itself. Now imagine this. Even if I am not a big fan of triple leverage ETFs, the TQQQ, which is the triple leverage ETF on Nasdaq, was down to 20 not long ago. Today sits at over 70. If you want to get fancy, the SOXL, which is the triple leverage ETF for semiconductors, it was down to 8. Today it sits at 150, 160. Now you would have bought that ETF at 8 and sold it at 160. That's 20x your money. You will 20x the portion of your current portfolio that you have in Treasury bill ETFs. What I do for Treasury bill ETFs, I usually buy BIL bill, which is the 1 to 3 month short-term Treasury bill ETF provided by Treasury, that pays about 4% dividend yield. Of course, that yield is going to fluctuate with the Fed interest rate. Usually pay around the first of the month and they charge 13 basis points, or TBLL, which is the same thing by Invesco. They charge 8 basis points. They pay around the ex-dividend of the 20th to the 24th of the month, and you can then scatter those incomes. When the opportunity presents itself, you are going to have your dry powder right there to deploy it at once or around the bottom. It is important that you take the temperature of the market. Right now, the market is hot. It is overpriced. Can it get more overpriced? Yes, it always does. But sooner or later, the music is going to end. In the meantime, you are collecting the 10% income from CCD, plus you are going to collect the nearly 15% income from QQQI. If the Nasdaq was to go up, the QQQI too is going to go up, less than the Nasdaq would, but you're gonna capture that appreciation at the same time. Guys, I can't bring myself right now to buy individual stocks, even if it appears There are a lot of opportunities out there. There are a lot of good company stocks being trending down, like Nike, PayPal, Adobe. Most of the software stocks getting hit by the SaaS apocalypse. I would stay away while the broad market is sitting at all-time highs. I just couldn't do it. I would rather invest in funds that are strictly connected to the S&P 500 or the Nasdaq, and that's why I picked the QQQI. I feel comfortable with NEOS, just as comfortable as I would feel buying JEPQ provided by JP Morgan or GPIQ provided by Goldman Sachs. NEOS pays a slightly higher dividend yield, and they are well established on the market with their most famous covered call ETF, SPYA. They sell covered call against the S&P 500. So to recap all this, I got 40% into QQQI to capture appreciation and collect a 15% nearly dividend yield, rain or shine. I got CCD that provides a 10% stable income annualized, and the dry powder, which is Treasury bill ETFs. Your money is going to be there when you need it. In the case of a stock market correction, people are going to flock to safe havens, and Treasury bills are one of them. The principal is gonna go up. Eventually, you're gonna use that money to deploy into your favorite stocks or favorite ETFs, and you're gonna buy at your favorite price. Peace out, everyone.